Understanding laddering, a key financial strategy. Laddering is a financial strategy that is prominently utilized across different sectors of finance. While its applications may differ depending on the context, most notably in retirement planning and securities underwriting, its foundational principle revolves around creating a structured approach to investing that enhances cash flow and manages risk. Key definitions and contexts. What is laddering? In financial terms, laddering generally refers to an investment strategy that involves accumulating a series of assets across different maturity dates or purchasing assets sequentially over time. By implementing this technique, investors can create a predictable stream of income while simultaneously managing risks associated with interest rates and reinvestment. Common usage of laddering. 1. Retirement planning. Laddering is extensively used in retirement planning, specifically among fixed-income investors. The goal is to mitigate interest rate risk and reinvestment risk through a combination of financial products such as bonds or certificates of deposit, CDs, that have varied maturity dates. 2. Securities underwriting. Conversely, in the context of securities underwriting, laddering takes on a negative connotation. It often refers to an unethical or illegal practice by which underwriters provide favorable pricing to select investors before an initial public offering, IPO, thus circumventing fair access for the general public. Fixed income laddering explained. One of the most popular forms of laddering is known as a bond ladder. This strategy involves purchasing a range of bonds with staggered maturity dates. For instance, an investor might acquire bonds with maturities of 1, 2, 3, 4, and 5 years, each totaling an equal amount. Upon maturity, the proceeds are typically reinvested into a new bond with a longer maturity, thereby maintaining the ladder structure. Benefits of fixed income laddering. 1. Cash flow stability. By structuring investments across various maturity dates, investors can expect a more consistent cash flow, reducing the fluctuations that can occur when relying on a single long-term investment. 2. Interest rate management. Since shorter-term bonds are generally less sensitive to interest rate changes than longer-term bonds, a bond ladder can help to insulate investors from significant price fluctuations that can occur in rising interest rate environments. 3. Reinvestment risk mitigation. The reinvestment of maturing bonds into new longer-term bonds helps investors capture potentially higher interest rates while protecting themselves from having to reinvest all their cash in a potentially lower rate environment at the same time. Practical example. Consider the case of Michaela, an investor at 55 years of age preferring less volatility as she saves for retirement. She strategically invests $500,000 in a bond ladder spread across 5 bonds maturing from 1 to 5 years. As each bond matures, Michaela reinvests the proceeds into a new 5-year bond. This approach allows her to leverage the benefits of higher interest rates while limiting her exposure to sudden market changes, thereby ensuring sustained cash flow and capital preservation. Laddering in IPO underwriting, a warning. While laddering can be a beneficial investment strategy in retirement planning, it is vital to be aware of its negative implications in the underwriting context. The practice, known as laddering in the IPO process, entails underwriters offering shares at a lower price with the understanding that the investor will later purchase additional shares at a higher price post-IPO. This not only disadvantages ordinary investors but can also lead to serious legal repercussions for involved parties, as it is considered a manipulation of market integrity. Frequently asked questions, FAQs. What is interest rate risk? Interest rate risk refers to the potential for investment prices to fluctuate as a result of changes in interest rates. For example, as interest rates rise, the prices of existing bonds tend to lower, impacting those who may need to sell before maturity. Laddering helps to shield investors from this risk since they generally hold bonds to maturity. Why do investors ladder bonds? Investors ladder bonds to create reliable fixed income cash flows and manage both reinvestment and market price risks. This is crucial for those who rely on these investments for funding retirement or other income needs. Is a shorter-term bond ladder better than a longer-term one? The advantage of a shorter versus longer-term bond ladder often hinges on individual objectives. Shorter-term bonds typically offer lower yields but come with reduced volatility, while long-term bonds may provide higher returns but can be more sensitive to changing market conditions. Conclusion: laddering is a versatile strategy that can help investors attain a balance between risk management and cash flow certainty. By understanding both the benefits and potential pitfalls associated with laddering, especially in the context of IPO underwriting, investors can make better informed decisions that serve their financial goals effectively. Whether applied in fixed income portfolios or to navigate securities markets, mastering the art of laddering can enhance an investor's financial strategy as they approach retirement or manage their investment portfolios.